Okay, welcome, ladies and gentlemen, to the Frontiers in Quantitative Finance seminar. This seminar is brought to you by the Oxford Mathematical and Computational Finance Group. And we thank our sponsors, the Citigroup and Mosaic Smart Data, for supporting this seminar. We've been holding it in the last year online, and we hope to return to a in-person seminar in 2022 in our usual London venue. We will keep you posted about that. So, but tonight we're very pleased to have as our speaker Professor Alex Lipton. So Alex is an old friend, and he's a very well-known member of the quantitative finance community. Well, I'm going to spend a few minutes introducing him because it's always a risky thing to tell somebody else's bio, but I think in this case it's interesting to know where Alex comes from, because he's done many different things, and a seminar like this is also an opportunity to know the people who are presenting. So Alex, if I understand correctly, started off in magnetohydrodynamics.
Yeah, very true. Yeah,
which is a typical, very hot topic, because you're dealing with plasmas at very, very high temperatures. So you can say that he started off in hot topics, and and he worked in this area where he made many important contributions, also related to astrophysics. And then he moved to the US from Russia, and there he worked first as a consultant at Los Alamos, which is known to people involved in physics because it was the birthplace of the atomic bomb there, although he didn't build any bombs. And then he spent some time as a professor of mathematics at the University of Illinois as well. But then he moved into the finance area, where he worked at many different financial institutions, including Bankers Trust, Deutsche Bank, Credit Suisse, Citadel, where he occupied various functions as senior manager and management of quantitative research. And most recently, he was co-head of the Global Quantitative Group at Bank of America. Then so during all this period, he made many important and interesting contributions to quantitative finance, especially in the early days. He made many interesting contributions to Forex, to the topic of FX modeling. He has a very interesting book on this, a very early book on this topic. In 2000, he received the Quant of the Year award by Risk Magazine, and it was the first award of this type. And more recently, he again received the Quant of the Year award from Risk Magazine in 2021, but for a very different type of work he's been doing more recently. So in the recent years, he's been involved with several fintech companies, including the Sila, and he's also had academic appointments at the Hebrew University in Jerusalem, MIT as a Connection Science Fellow. And more recently, he has joined the Abu Dhabi Investment Authority, where he will be involved in the quantitative research functions. So after this quick bio, which does not do him justice, I'm sure, I'm very pleased to introduce him for his talk tonight. So he's going to talk about some recent work he's been doing on automated market making with blockchains. He's going to tell us more about that. Thank you, Alex.
Thank you, Rama. Very kind of you. And of course, it's a privilege to speak at your world-renowned seminar, which generally is quite interesting, even though I seldom attend it, to be perfectly honest, because of other things. But nevertheless, it is a very important initiative, and I'm really honored to take part in this program. So today I want to talk about my recent work on Forex trading using consensus as a service on blockchain. And the talk consists of sort of three parts. One is introductory into blockchains and distributed ledgers in general. And then one is about intrinsic sort of transactions within the blockchain itself. And this part is done with my colleague at MIT, Thomas Harjona. So we think about it as interoperability on blockchains. And then the third part, which is the key, the main sort of emphasis of this particular presentation, is about exchanges of fiat currencies, and that is done with Arthur Sepp, who used to work for me at Merrill Lynch and then later at Bank of America, and currently is head of structuring for Signum, an innovative, completely digital bank with a license in Switzerland and Singapore. So basically, what I want to talk about are these new developments in this whole area. And we live in an interesting time when some of the concepts which held true literally for millennia start to change. So one of those is the observation by Aristotle, who said that money was derived from law rather than occur by nature, right? So in the true classical antiquity tradition, it was important for Greeks and Romans to derive meanings from words, and so he derived the meaning of money, nomisma, from the meaning of law, nomos, all right? But it actually held true, as I said, for a very long time. But now, for the first time, we can see that value of crypto money is not derived by law at all. That is an interesting observation. It's not derived, but essentially the value is in its entertainment value. I understand that many people who are crypto enthusiasts will probably disagree, but nevertheless, at least, what we all can agree is that entertainment plays an important part in this whole journey, right? So that's interesting by itself. Right. So essentially what I'm going to talk about in the first part of the talk is covered in much more detail in my recent book with Adrian Tricani, and that's more or less a sort of main source for the first part of the talk. And then another book which also was published last month, this month, and the other one was last month, that is with Pentland and Harjona, and it covers a little more broadly data as capital and whatnot. So before we go into figuring out how to exchange money, we need to figure out what is money. Attempt to answer this simple question invariably fails because reasonable people disagree, and so essentially it's probably easier to describe money by its function. And so money is viewed as a medium of exchange, means of payments, particularly taxes, but more generally, of course, money as a store of value, unit of account. And finally, so these kind of 5 or 4, if you wish, attributes have been known for a very long time. This one I coined myself, and it's kind of rooted in my experience to which Rama alluded as a quant in forex arena. So money is a perpetual call option for acquiring goods and services and discharging one's obligations. So basically that's kind of a slightly different angle. And however you define it and however you kind of view it, one fact has also held throughout, for millennia as well, that regardless of how you build your money, it tends to lose its value. So at the top, we see how the value of content of silver, so this is a metal money based on silver, were going down for the Roman denarius. And you can see that after about 250 years since the first emperor came into power, it pretty much lost all its value. And here is the value of the US dollar from the beginning of the century the 20th century until our own time, and so far dollar has lost maybe about I'd say 90+ % of its value. So regardless of whether you have kind of gold standard, silver standard, which is actually more common, or fiat, the trajectory is invariably down. And so what we want to do is to think about various things. So how we can potentially replace kind of existing money with something else if it is really necessary. And also whether we can bring money closer to what is needed for our electronic age. And the question is, why do we need to do it in the first place, where it seemingly things are working all right? Money kind of in a developed country, provides that you do have the money, you can move it around, etc., etc. But nevertheless, one objectively speaking, the existing banking and payment system, as I said, it's still working, but it is quite obsolete and it's no longer aligned with the requirements of the modern world. So that's an observation which is important to keep in mind. It's just too dated, so to speak, right? And one of the things which makes the system particularly kind of in a particularly kind of dangerous state is that we have persistent negative or very low positive interest rates, which very, very slowly starts to change in front of our own eyes because of the raging inflation. But since the global financial crisis, in fact, before it, rates were very, very low, and that is quite bad for the financial system the way it is organized right now. And the third observation is that we got, by the development of internet protocols, kind of, they unleashed creativity and growth in numerous fields, such as the development of Google and Amazon, and for that matter, even Facebook, even, of course, kind of, it doesn't seem like development of Facebook is such a great thing. It's probably negative overall, but nevertheless, it certainly is creative, right? So, but the same creativity still has not been observed in banking, even though, it's app-based, digital banks and whatnot, but the reason why there is no explosion of programmable money and things like that is because the access protocols, like akin to internet protocols for money and identity, of course, they're very badly needed if you want to develop things, but they're conspicuously absent. And what I would like to argue is that if we judiciously use blockchain technology and build properly fiat-backed tokenized medium of exchange, that can at least, play the role of internet kind of electronic, money on the internet, that sort of thing. So basically, if you wish, you can sort of think about this as filling this gap, which was left by the giants who bequested us the internet protocols, right? So this was one thing which was missing. We can possibly try to fill it, right? So by using this tokenized medium of exchange, we can have, a flourishing fintech ecosystem and develop all kinds of interesting things, such as decentralized financial market infrastructure, a very interesting direction, and decentralized finance, which is currently all the rage, so to speak, right? Why is it necessary to do something if we already have something which is working? And as they say, if it's not broken, don't fix it. The thing is that it's not really broken, but it's very close to being broken. And besides, they say, for example, financial system, and here is a grossly simplified picture of how the settlement system in the United States operates. You can see that it is already extremely complicated, right? And so the idea is to try and use the blockchain in order to build an alternative to the existing system, right? So the definition of blockchain, essentially it's a shared distributed ledger which facilitates the process of recording transactions and things of that, and it's a sort of idea articulated by IBM and many other people. And you know, kind of numerous transactions take place, and if we manage to organize them in a proper order and put it into an immutable ledger, we would be at a considerable advantage, right? So here I want to emphasize that since we deal with systems where there's no kind of universal clock, you know, the sequence of transactions, which actually plays an important role, you know, cannot be established for certainty. So essentially, kind of, it will be established as part of a competition, and sort of, you know, even if I were to kind of send money to Rama before Rama sends money to somebody else, the system can actually record it in the opposite direction. So that might potentially have some consequences. So you have to bear in mind that fair kind of time stamping is not really possible in this setup. Then we can ask ourselves, how do we want to organize information overall? And here are three potential ways of doing it. On the upper left corner, we have a centralized system. On the right, we have decentralized system. And finally, in the lower left corner, we have a distributed system. And so examples, of course, are numerous, and they can be observed in nature and in society. But at the same time, the easiest for us in the context of mathematical finance is to envision, you know, banking system in one country is organized in a centralized way, where the first node is representing the central bank, and others are private banks. And the interesting thing is that when you say, for example, JP Morgan sends $100 million to Morgan Stanley, reality of the situation is that it cannot go from one bank to the other directly. It has to go through central bank, and lingua franca of the banking system in this context are electronic deposits of commercial banks with central bank. And the whole thing is very heavily regulated for a variety of reasons, not least of which is that the system by itself can create and destroy money as it wishes. So the decentralized arrangement would correspond to several economies where banks, you know, kind of exist in different currencies, so to speak, and then nodes 1, 2, and 15 represent central banks and corresponding geographic locations, and other nodes represent the commercial banks. And finally, this distribution at the bottom is what we want to have, so blockchain. So make no mistake, when you say that, you know, nodes are linked to each other, it doesn't literally mean that every node is linked to every other node, but just that there are so many passes between one node and the other that the whole system sort of operates as a whole, you know, as a whole, so to speak. Right, and of course, there is a variety of distributed ledgers we can think about. Unpermissioned public ledgers, these are the protocols which actually launched this revolution. So it's Bitcoin protocol, Ethereum protocol, and all kind of imitators or kind of people who want to improve these protocols and things like that. Permission private ledgers like R3, IBM, and many others, you know, they try to take parts of the, you know, ledger thinking, if you wish, but eliminate some of its kind of important bits and pieces which are particularly pernicious. That is how to establish you know, how to establish the consensus, so to speak, because if different parties think of the state of the chain in different terms, then of course the whole thing will collapse. So essentially, that's very important that there is consistency for all participants who don't trust each other necessarily, know each other, and so on and so forth. So it's quite an ambitious task if you think about it. And finally, at the very bottom of this, by way of complexity, is traditional centralized ledger. And as I already said, the blockchain is only worth its salt if it can maintain its consistency, right? And so and for that you need to use a variety of mechanisms. The most interesting in some sense is proof of work. That's what the classical Bitcoin protocol operates out of. Of course, you know, by design, this proof of work the very name of it, the fact that you need to do work, essentially means that in the context of electronic environment, it means that you need to burn electricity. And, of course, we all know and frequently discuss that Bitcoin is a voracious consumer of electricity on par with mid-sized countries. Then, of course, you can do a proof of stake, which is much more similar to conventional shareholder capitalism and that sort of thing. Proof of burn and all kind of other variations. So this team that you need to, consume something in order to opine on the state of the blockchain. Byzantine fault tolerance, that's kind of much closer to the classical computer science and things like that. Finally, you can use third-party verification by notaries, and some of the blockchains better known, for example, Ripple, uses this type of arrangement and so on and so forth. But if things are done properly, and instead of this very complicated settlement system, which I referred to in the past, in the opening slides, here in principle, you can have two nodes, Alice's node and Bob's node. And by the way, you can immediately recognize that whole thing was built by cryptographer. Whenever buyer is called Alice and seller is called Bob, that's kind of cryptographic, pedigree is immediately obvious. And so essentially, Alice has a wallet or node, Bob has a wallet and node, and Alice, provided that she has some value, she can say, I want to send this value to Bob. Essentially, she sends a Twitter to the rest of the blockchain. So there are miners, people or organization who maintain its integrity, then full nodes who just record the state of the ledger, and then there's kind of this wallets of various agents who use it. And so that's basically, provided that Alice is a legitimate owner of funds, they will be transferred to Bob, and the ledger will make the corresponding kind of reflected accordingly, right? So in principle, it's much easier to a large degree, right? And so the first protocol based on this principle was, of course, the famous Bitcoin protocol, which made grand promises to replace national currency, remove money from social and governmental control, provide anonymity, decentralization, and whatnot, right? Reality is that it is indeed a staggering technical accomplishment. Make no mistake, right? So I have been working for banks for 20 years. And when I started my work at Bankers Trust, we already were engaged in rewriting our global analytics and so on and so forth. And when I left Bank of America 20 years after, we were still kind of engaged in rewriting our analytics. And it's a kind of a never-ending task requiring a lot of effort, and meeting modicum of success by and large, but nevertheless extremely difficult and prone to errors and stuff like that. Whilst Bitcoin was created like the goddess Aphrodite, all in one piece, or practically ready to go. There were a few teething problems in the very, very beginning. It happened actually in January of 2009, the very end of, January of 2009. For the first few months, there were kind of issues of minor importance, and then it started to work without any hitch and continues to work until now, right? So it grew enormously. The value kind of reached more than $1 trillion from $50 or whatever, and it's quite a remarkable accomplishment. The other thing to bear in mind is that it was really not such an original thing. So the genius of Satoshi Nakamoto, whoever he or she or they might be, was that they judiciously combined existing cryptographic primitives and kind of in a blend, which kind of emphasize the strengths of every particular ingredient and put them into an imitable whole. That's quite interesting. Having said that, transactions per second are very low. So say nominally people argue that it's 6 or 7. Reality is that it's more like 5. The decentralization is not quite there because there is a continuous struggle for control between different mining interests, and that kind of interest which really matter in maintaining this protocol. Pseudonymity is at best. Anonymity has never been accomplished, and if you think about it, cannot be accomplished provided that all transactions are public. Centralization, which I will explain momentarily, etc., etc. Yet it can be viewed as an electronic version of treasure, and also as something to aspire to, a very, very solid piece of engineering, which actually works quite well. So basically, of course, one thing which is very important to understand is that the price of Bitcoin is really not related to, is not directly related to the operation of the protocol. And so the price is established as part of a supply and demand, equilibration, if you wish. And the way I like to think about it, and I'm sure that other people will disagree, but this is my view, is that Bitcoin has no value. However, it doesn't mean that it should have a zero price. Au contraire, what it really means that the price can be anything. So essentially, by virtue of having no value, you can have any price, right? So that's a big difference between what the detractors of the coin say and its proponents. And by the way, in the interest of full disclosure, I want to emphasize that I'm not advocating for or against Bitcoin, making no recommendation whether you should buy or sell or kind of stay away from it. It's entirely up to you. I'm just making my own observation of how the whole thing operates, right? And so the price of Bitcoin goes up and down, and in reality, you kind of see these big peaks and troughs. But if you look at 2014, you can see a tiny blip, which in reality was a huge blip at the time. And so the price went to $1,000, then went down to $100, etc., etc., etc. So these convulsions going up and down, bubble burst, are very, very typical for Bitcoin, precisely for the reason which I articulated earlier, that is that you cannot establish a fair price for it, right? And so if you think about the protocol as a whole, what it is, it's a gigantic Markov chain with constantly increasing number of nodes. So it's not a fixed, kind of fixed number of nodes Markov chain. And in fact, Rama, maybe we should talk about it offline, what it really means from a mathematical perspective. But at any rate, these are kind of addresses or wallets which contain this unspent transaction outputs. So there are no Bitcoins per se. It's a kind of shorthand for unspent transaction outputs. Then, as I said, miners who maintain its integrity tend to accumulate for convenience these transactions which have been broadcasted by agents into blocks, and they engage in this proof of work competition where winner takes all, the right to approve a new block. Once you approve a new block, you receive an award from the system itself. So from that perspective, it's quite interesting. And then, you get a new state of the world. So that's basically how it works, kind of for Bitcoin. But what we really need, but Bitcoin is at the same time quite ingenious and very primitive. The primitivism of Bitcoin stems from the fact that all it does, it moves value from one wallet to the other, and that's it, essentially. By very contrived set of, idea, kind of mechanisms, you can also attach to it a stable coin, which is called Tether, but this is done at the level of the Omni layer, and Omni layer is quite awkward, take my word for it. Anyway, so that's how Bitcoin operates, and of course, it's not enough. It's an interesting start, but it's not what we want if we want to do exchanges and stuff like that. But before we go to how we can potentially do this, this is what I promised to say, is that miners, lonely miners, well, being lonely is actually dangerous from a financial perspective, because they getting rewards in this competitive game directly depends on how much hash power you control in order to participate in this game. And if you're by yourself and control a tiny portion, the probability of getting the reward is very remote, even though in fairness, kind of anyone can get reward. So it's just proportional to the amount of effort you exercise. But if somebody exercises 99% of the effort, they will get a reward much sooner, and you will get out of business because it's very expensive to be a miner. And so miners try to share sort of risk and rewards by organizing themselves in gigantic pools. And in the kind of in the pie chart below, you can see for a particular day what were these pools, and the fact that you actually see this very large portions controlled by a pool suggests that the whole thing is not really decentralized as claimed, right? And so, but as I said, the goal of Bitcoin is very, very limited. And then Ethereum decided to, developed by Vitalik Buterin and a few others, decided to address this issue by adding capabilities for the protocol to use smart contracts, and in the opinion of its developer, become a virtual Ethereum virtual machine. What they claim is the first distributed Turing complete computer, and it can support all kinds of things, including distributed autonomous organizations and the like. But reality of the Ethereum is simultaneously impressive and depressing, because it still has low transaction per second and uses extremely obsolete payment method, which makes paying for even simple transaction within Ethereum protocol is very, very expensive, right? And yet it is kind of sufficiently robust and can be used for various things, such as ICO. That was a craze a few years back. Right now, it's probably better to say NFTs, non-fungible tokens, and so on and so forth. But as I said, the way I think about Ethereum is that it is a consensus as a service provider. And again, we can see this typical ups and downs in the cycle of life cycle of Ethereum, and which are associated with ups and downs in the Google trends and interest in the product itself. The difference between Ethereum and Bitcoin protocols is that, in addition to externally controlled nodes, which are the same as in Bitcoin, it has smart contracts, which are essentially code snippets, which can be exercised, by complicated rules. And so now in the block, there is not only a simple transaction for moving Ethereum from one address to the other, but also complicated transactions and or sequence of commands which change the state of the smart contracts themselves. So it's even more complicated setup than Bitcoin. And so the good thing about the smart contracts is that they can provide anonymity, trust, reliability, savings, and accuracy. But as everything else with blockchain, whatever is an advantage can become disadvantage if you do things wrong. So for example, reliability, they can be not reliable. Accuracy, they cannot, and can be very expensive. And the thing to bear in mind when you decide to execute, build or execute a smart contract is that if you do a bug, then the philosophy is such that the code is law, and so whatever is written in code is right. There is no concept of bug per se, but the code can operate quite in the opposite direction of what you wanted to do, and you cannot stop it, right? So you cannot stop it because it's just designed this way, right? So smart contracts are programmable financial instruments, and Ethereum, as I already mentioned, provides consensus as a service. And the good thing is that, well, a bad thing depending on the circumstances, is that transactions are visible to all, and smart contracts are visible and auditable by all. And as I already mentioned, it's simultaneously a plus and a minus. And the other thing to bear in mind that, as I already mentioned, the actual payment system is extremely obsolete, and so paying for consensus can be extremely expensive, right? And so Okay, but nevertheless, with this idea in mind, we want to ask if we have consensus as a service, can we build something other than a native token, which is Ether, or a similar thing in Bitcoin, which is BTC? Because as I mentioned, and you saw in the graphs, price goes up and down quite violently. And so paying with Bitcoin or with Ether for goods and services is a sort of very kind of iffy proposition, if you wish, right? So it's interesting that here in Dubai, you can, actually pay with Bitcoin for rent, which is interesting. But at the same time, if you look at how much rent costs in, say, Bitcoin, it's like 3 times more expensive than in fiat, so, which means that it's a kind of it's a gimmick more than a real possibility of paying. But the thing is that if you use the smart contracts, you can basically build potentially the kind of most foundational thing would be to build central bank issued digital cash or digital currency. And, this is something which many central banks, including the Bank of England and the Federal Reserve, and everyone and his uncle or her uncle are discussing. Very few banks are designing it. A best known example is, of course, electronic version of the Chinese renminbi. But for the enthusiasts, I need to give a word of warning, because it's not really a blockchain based. The other thing is that central banks are relatively small, and even though they're kind of powerful institutions, but they kind of technically, they're just not capable of building this central bank digital cash. Much like in many countries, they do not really print their own currency and outsource it to specialized firms. Same here, I would imagine that if central banks were to go into this route, they will probably outsource it to banks. My ideal solution would be to do it through narrow banks, which are banks with kind of assets solely consisting of government paper and electronic deposits with central banks themselves. And sort of much like, armies do not, or navies do not really build their own ships, but rather order them from contractors. Same story here, right? But whether or not it's gonna happen, it's anybody's guess. And I would not necessarily hold my breath to see a central bank digital currency issued by a major bank like the Fed, for example, anytime soon. And so in lack of this digitized cash, what we can think about are stable coins, which would be privately designed tokens, which hold value and can be transacted on blockchain, right? So we can think about fully collateralized custodial tokens over collateralized with cryptos, and finally something which is perennially discussed but never delivered, dynamically stabilized tokens, right? So the fully fiat collateralized coins, of course, is the most kind of straightforward thing to think about, where essentially the issuer of this coin uses a smart contract to control the number and transactions and transact them in a consistent way using, for example, Ethereum or any other protocol like Corda or Solana, Cardano, I'm sorry, not Corda, Cardano or Solana, for the purposes of maintaining consensus. And then, it's one-to-one. So essentially you need to pay, $1 to get $1 worth of stable coins. And then when you're finished with the stable coin after a few transactions, you can return it back and get your dollar back. Of course, with some haircuts for transaction cost and things like that. And so there are several coins, of which Tether is the best known, but the most suspicious. Recently Bloomberg published a large expose where they argue that it's not really covered by one-to-one with fiat, and nobody knows what it is covered with, if at all. But there are others which are more solid, like True USD and others. And in the interest of full disclosure, I have to say that the company which I co-founded also has a token which is called Sila, and which we use for real life transactions and sort of in real economy. We are not really aiming it at cryptocurrencies per se, right? And so then, of course, the other possibility for those of us who have long memories and were involved in this field, before and during the global financial crisis. Of course, the other things are CDO tranches, and that's the idea behind some of the best known over collateralized coins such as DAI issued by MakerDAO. So the idea is that you put in, say, for example, $200 worth of Ethereum, and you receive $100 worth of DAI, and then kind of essentially it operates like a glorified Lombard. For those of you who know what the concept of Lombard is, and where they say Lombard Street is kind of opposite the Bank of England, that's where people kind of put some collateral in the form of valuables and so on, and receive money, and then they have to repay money with interest, and then they can take their valuables, and if they don't have enough money to buy the valuables back, then the valuables are liquidated. And of course, for I don't know, if 200 worth of valuables, people are given maybe 100 worth of money, and so essentially they have an incentive to pay the money back. But when it goes to that, it might not be possible. But anyway, so that's the same idea taken to the 21st century, and kind of done like this. And of course, the problem with this is that people who really rely on this type of technique can be forcefully liquidated. So this margin calls on steroids, right, so to speak, right? The other thing is that it's not like in conventional finance where people put $100 and control 1,000 or even more, in foreign exchange trading. Here, it's the other way around. You put 1,000 and you control 500, that sort of thing. So it's kind of, it goes against the grain. And then, as I said, I will, even though it's an interesting topic, I will not talk about it because I don't believe in it for a moment that it is possible to build a dynamically stabilized coin. But anyway, so I'm sure I'm opening myself to criticism, but that's for the fun of it, right? So anyway, so what I'm trying to say is that now, if we think about Ethereum as a consensus as service provider and a stable coin, whether it's fully collateralized with fiat or collateralized with crypto itself, but this is a foundational layer in order to build a decentralized finance. So decentralized finance, it moves away from centralized system to peer-to-peer finance. Shouldn't be confused with, say, peer-to-peer lending, which was all the rage a few years back, but not anymore. And in general, it's a different story. But at any rate, what you can have decentralized exchanges, kind of decentralized foreign exchange. That's what I'm going to be talking about, and many other things, right? So I don't have time to cover them all, but there are many things, right? And so the most sort of the least revolutionary but interesting as a first step is interoperability. That is the term which I think Thomas Harjona and I coined for the purposes of describing what's going on. And as I said, there might be several stable coins, and here you can see USDT, which is Tether. You can see USDC, USD coin, True USD, and so the price goes up and down around one. And you can kind of think about, is it possible to exchange one stable coin into the other? As I said, it's not revolutionary, but as a first step, it's interesting. And so the idea is to use automated market makers, and by now there are quite a few, so something like such as Uniswap, Balancer, Curve, and many others. And kind of you can basically use any of those in order to try to have an automated exchange without any external parties, which is executed through smart contracts. And the volume which is engaged in this type of activity is quite big. It's about 100 billion US, or maybe more. And so here is the idea. So the simplest one is, suppose you create a pool of liquidity where you put two tokens, token one and token two, in such a way that the sum of the the total sum of first token, the number of first token plus the second token is kept constant, right? So that is, of course, a little naive, even though not particularly so, but a little naive system, because the moment one token changes price vis-a-vis the other, say y with respect to x, either one or the other would be immediately wiped out, and the liquidity pool will consist of only one token. Oh yeah, maybe I'm sorry, I'll step back a little bit. So you have this, and then anyone and his uncle has the right to choose whatever coin they want to take out by replacing it with the other coin in such a way that the sum is preserved, right? Plus a little transaction fee, of course, in order to maintain all this thing meaningful, right? So if you think about it, once y becomes more expensive than x, it's kind of beneficial to take all the y, replace everything by x, and completely wipe it out, and the other way around if the opposite is true. So what there's a kind of, as a simple idea, it's clear, and the price, the price of one token with respect to the other is just dy by dx, and it's just always one. Now we can sort of look at a slightly more advanced thing and do the constant product rule, and there we say that the product of x times y is kept constant, right? So if we do this, then things cannot be wiped out. They cannot be wiped out. So basically, eventually, if you deviate from the equilibrium too far, the price of taking one token out becomes just prohibitively expensive, because it's just p naught divided by x squared, and so you will stop kind of doing it. So this type of pool of liquidity can never be totally exhausted. And then, of course, mixed rule, it's a combination of the two, and it's written here in equation 6, and it's the most interesting one because it gives the most interesting kind of dynamics for all this thing, right? So here in this graph, I show this, total sum, and at the bottom, product, and then, this mixed rule. So basically, mixed rule is a between product and constant sum, and the price of one token vis-a-vis the other is given, as I said, it's constant in constant rule, hyperbolic in constant product, and a more complicated shape in the case of mixed rule. Now, what will happen if you create this liquidity pool and open yourself to being arbitraged by whoever comes, will result in the fact that you will have, of course, every particular arbitrage will result in loss for you as a pool operator. However, the idea is that if the prices are reverting, then eventually, the kind of goes up and down will sort of balance each other, and so you will sort of not suffer this, especially because you also charge a little transaction fee, so that should compensate for that, right? And so kind of impermanent loss can be written easily for constant sum and constant product, and it requires a little arithmetic for mixed rule. But at any rate, if we look at, for example, what would happen, how the constant sum will be arbitrage, so you can see that, arbitrager will wait for the equilibrium price to move a little bit away from one, because of the transaction cost and whatnot, and then, jump on it. And same, and so as a result, the kind of portfolio will suffer a loss compared to the buy and hold portfolio, which depends on where the overall price of the pair will end up with. So this lambda is kind of is relative loss. And so the constant product is kind of roughly similar. So basically, when the price deviates from 1, which was the original price, then you have to have square root of p of x's and 1 over square root of p of y's. And you can also calculate the optimality condition. And the loss, impermanent loss, would be different compared to what it was before, and it's given by this equation 23 here. And finally, for mixed rule arbitrageur, it would sort of, you will not be able to express it explicitly because, you need to solve a little nonlinear equation, but in the end, it will all kind of come up together. And so we can see, kind of what would be the composition, the number of x tokens in the pool depending on the price of various things. So as you can see, it goes up and down. For constant rule, it's either 0 or 2, and for constant product, it's like this square root, and then for mixed rule, it's a combination, and then you can see the impermanent loss, right? So essentially, the most interesting thing is that for the mixed rule sort of impermanent loss is a particular kind of sensitive, right? And so the profitabilities in the end is you compare the buy and hold with what you can get from there. And essentially you need to bear in mind that every transaction, you actually add a little bit to the pool, because when you take something out, you need to put something in a little more for transaction costs. And here on this graph, I show the distribution of P&L, for this exchange of USDC, TUSD, that's kind of relative P&L. And then on graph B, we show the value of this product, which was initially one, which we started with, but after so many exchanges, it actually now distributed more about 108. So basically, for a particular simulation and specific choice of parameters, I skip completely how I exactly did the simulation. This is described in this paper with Thomas Harjona, which will appear as a chapter in the book published by Babbage and others, but Springer Verlag. But essentially, you can see the idea. So essentially, being a market maker is more or less profitable, even though maybe not hugely profitable, but profitable nevertheless. And the profitability comes from the fact that the composition of the portfolio is constantly drifting in your favor, right? Now, we can ask ourselves, can we use the same technique in order to exchange, rather than internal thingies designed by blockchain aficionados, into actual fiat currencies? And whether or not we reach the stage where we can cleanse the temple of high finance. So here is a famous fresco which was painted around 1305 by the Italian pre-Renaissance artist Giotto, kind of ordered by a famous money changer Scravengi. And so he felt, of course, that he's doing something wrong. And so basically the fresco is showing Jesus Christ expelling money changers from the temple, right? So it did not really work very well, because money changing continued to be the most fundamental financial operations since the time of when the temple was still standing to nowadays. But what I'm arguing is that by using automated market maker, maybe now is the time when we can replace conventional money makers with smart contracts. So that's the question which I want to posit, and the details are given in joint paper with Arthur Sepp. And the idea is that you can repeat what I explained in some detail in the previous kind of framework for stable coins. You can actually repeat it for real fiat currencies, where you think that they are mapped onto the same blockchain in the form of stable tokens, right? So fully collateralized, for example. And if on the other hand, we are patient and development move in this direction, if there are central bank digital currencies, then probably they will be implemented on different blockchains. And then, of course, there should be some mechanisms for enforcing blockchain interoperability, not to be confused with intraoperability, which I was talking about. So intra and interoperability is covered with in my paper with Harjona. This is just an assumption that you have both fiat tokens on the same blockchain, and then you can see how the portfolio will be balanced and all that type of thing. And you can see also the distribution of P&L for real dollar dollar euro pair, and how it depends also on the amount of transaction cost which you charge, and this parameter alpha, which describes the mixed kind of rule for the automated market maker. And as you can see, especially too many graphs, I don't want to dwell all of them, but this one also shows that for different alphas and different percentages, you have, you know, this kind of positive P&L by engaging in this type of activity. Of course, your P&L, as is shown in this graph, depends on the demand. So sort of how much, what kind of velocity of money you achieve in this pool and stuff like that. Because if nobody comes, then nothing will happen. But at the same time, because you open yourself to arbitrageurs, they will come volens nolens, right? And then finally, this is also true for P&L for all G10 currencies, and this is the analysis of the latter. And finally, the conclusion is that the idea of distributed ledger is not new. So it's basically have been known since times immemorial. And in fact, as Rama mentioned, you know, I hail from Moscow originally, and so basically there we use a patrimonic way of naming people. So I have my own name and the name of my father, and so my father had his name, or he passed away not long ago, but you know, his name and the name of my grandfather, and so on and so forth. And so essentially it's a blockchain in its own right, and so you can see it in many other things as well. And so potentially distributed ledgers are very promising in finance. As I already mentioned, conventional cryptocurrencies are harbingers of things to come, and maybe are things to come. Who am I to say yes or no? But in my mind, more conventional, more interesting things are in the area of digital cash, asset-backed cryptocurrencies, which I didn't have time to talk about, but it's also an interesting direction. And decentralized finance, whilst it's in the early stages and does suffer from numerous attacks and things like that, related to the fact that I already mentioned once, many times, in fact, and I'll repeat again, that stable and smart contracts are really hard to write in a proper way. And this is a sharp distinction between them and the foundational Bitcoin protocol. But nevertheless, assuming that this teasing problems are taken care of, that's quite an interesting development. And of course, if central bank digital currencies were to be developed, then it would be paramount for their success to have interoperability of the corresponding you know, blockchains. And I'm grateful to all kinds of people for that. And the other thing which I was asked to do is, and do it with pleasure, is that, you know, as Rama mentioned, I joined RD as a scientific advisor, and we have a research lab. And if you're interested in jobs, you know, do apply. And that's about it. Thank you. I'm done.
Thank you very much, Alex. Thank you very much for this stimulating talk and lots of interesting questions here. So we have time for some questions. So are there any questions in the audience?
Hello. Thank you very much for the talk. I would like to ask you about your opinion on the country of El Salvador adopting the Bitcoin, the cryptocurrency recently as a legal tender, and your thoughts on whether it's a matter of time until more countries do the same, and the long-term impact that will have on decentralized finance.
Well, it's a very interesting question, Georgios. You know, my own take on it is not sort of super enthusiastic. So I, you know, El Salvador is a small country with its fair share of difficult fiscal problems, and the fact that they adopted it, you know, it's interesting, but I don't necessarily think that it is a harbinger of things to come. There is also something which obviously, you know, I have any kind of visibility from the inside, but from outside I can just guess that the fact that kind of Salvador uses US dollar as legal tender opens kind of some very kind of, how should I put it, very specialized venue for people who have a lot of Bitcoin to actually convert it in El Salvador into dollars and be done with it without paying any tax on the capital gains, because if something is treated as a legal tender, then there is no tax associated with executing this type of transaction. Whilst, of course, in any other place in the world, in theory at least, and most likely in practice as well, if somebody liquidates a highly appreciated Bitcoin asset, they have to pay a lot of tax. So that's my take on it. I think that, look, I might be wrong, but my own feeling is that because of its volatility, it's very hard to use Bitcoin as a real legal tender. And maybe in the places where fiat is really kind of in super bad shape to start with, it can be a legitimate replacement, because there are places in the world where the value kind of dissipates so rapidly that anything which maintains that value is good. And as I said, Bitcoin probably can be viewed as a store of value. But you see, to use it as a currency for, first of all, it's technically not capable to do small payments, and in Salvador most payments are very small, of course, right? So it's it's used as a shadow kind of how should I put it, balance keeper, if you wish, right? So it's not like you really pay with Bitcoin for your coffee or something like that. Anyway, it's not possible. As I already mentioned, Bitcoin transacts about 5 to 7 transactions per second, and there is no way to accelerate it at the level 0. Of course, there are level 1 and 2 Lightning networks and whatnot, but that's not what's being done in El Salvador. And but also there is this thing that if it goes up like it was doing a couple of weeks, a week ago, you feel extremely stupid, right? So you essentially pay for your coffee with Bitcoin, and 2 weeks from now you can buy a bicycle, right? So you feel stupid. On the other hand, if it goes down, then the seller feels stupid. So it's really difficult, if you think about it, to transact in the medium which constantly changes its value. And so basically also Bitcoin, from what I understand, that I'm not a real expert in Salvador, but I think that it actually, prices are still shown in dollars, and it's basically you have to deliver an equivalent amount in Bitcoin. It's not like they tell you that your cup of coffee is worth say 100,000 of a Bitcoin or something like that. You see what I'm saying?
Any other question for Alex?
Thank you very much.
So I have a question for you, Alex. So,
of course,
so one of the issues that came up in the last decade in FX markets was this large-scale manipulation of currencies by certain dealer banks, and part of the problem was apparently linked to the market design, because a lot of these, it's a very centralized market. There's a small number of dealers. It was done through voice, so it's really all these design issues entered the manipulation lawsuit, and they're very interesting details of it. For example, for the London fixing, so my question is, does your proposal for automated market making avoid such problems, or is it not related to that, or does it?
Rabbi,
this specific type of manipulation is ruled out? Can one say this specific type of manipulation is ruled out by moving to an automated market making for these currencies?
It's an excellent question, Rama, and I myself posited it for when I was designing all these schemas. I would tell you like this. So right now, this this design initially sort of uses external prices and oracles, because you need to know what the prices are in order to manipulate, in order to transact, so to speak. So arbitrageurs need to use both the automated market makers and external liquidity providers at the same time in order to achieve this arbitrage. So from that perspective, of course, it doesn't solve the problem directly, but I know acutely what you're talking about, and you're absolutely right. You know, the structure of the opaque market with a few major players, that's, you know, it's kind of a recipe for this type of activity potentially. But the point which I want to make is that at the initial stage, these pools, which are completely transparent, quite paradoxically would play the role of dark pools in some sense in the equity market. For those of you guys who are not exactly familiar with this, dark pool is a pool which is privately kept by banks, so to speak, and it's a price taker from the public exchange, and then it is executed at the public price, but privately between large buyers and sellers in order to not to move the price. So here it's a really interesting situation. It's a completely light venue, but it is actually a dark pool. So, you know, but my kind of hope is that
the spot FX market does function like a dark pool as well.
Yes, that's right. I mean, but it's, yeah, but it is kind of yes and no, because, you know, spotted FX market is really kind of opaque completely, right? So it's basically two parties agree among themselves, and maybe you call a few brokers and sort of get the idea, etc. But yeah, eventually you have to agree with counterparty over the counter. But my hope is that if this idea picks up and becomes, you know, kind of, you know, more prevalent, then eventually simple composition of this liquidity pool will be an indicator of the price in its own right. So rather than taking a, you know, external price and trying to equilibrate the pool accordingly, you will just have the composition of the pool where dy by dx would be sort of your price. And so that's how I would envision the evolution of this ideas going forward.
Okay. Any other questions for Alex?